Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah, and over the next 25 minutes, we'll talk about one particular aspect of the of mutual funds in detail, and that is, yes, thematic investing, but thematic investing into pockets which have been very, very active. And I think what we've chosen today is defense, because that sector is the cynosure of all eyes, at least was the cynosure of all eyes until maybe 4 months ago, has done really well. And I'm sure a lot of people have either individual stock holdings or may have exposure through the mutual fund route into the defense funds or funds which have a higher exposure to defense as well. So with the bit of a pause that the sector seems to have taken, is it a good time to consider investing in a thematic fund which invests into defense, or an index fund which invests into defense per se? I think the right guy is to talk about this is Pratik Oswal, because he's the head of passive funds business at Motilal Oswal AMC, and they have an index fund and an ETF, I believe, which mirrors the defense index. Pratik, thank you so much. Good afternoon for joining in here, and thank you so much for joining in here. How do you guys think about, we'll come to the product, of course, that you have and how people can use it and why is it good, bad, ugly, but how do you guys at the margin think about defense, considering that it's a sector that has run really well in the recent past and is now taking maybe a necessary breather?
Great. Thanks, Raj, for having me on the show. So I think we believe this is a sort of needed breather for the space. I think there's been a lot of, I think run up in this space over the last 3 to 5 years time. And we believe that there's been a lot of investor interest in this space as well. A lot of investors who are not sure about which stock to buy, which stock to sell, they do rely on mutual funds to do the asset allocation. And we believe that mutual funds offer superior diversification because you're invested across different stocks. Unfortunately, Neeraj, there are not a lot of defense companies in India currently. We believe that over the next 3 to 5 years time, there'll be a lot more IPOs coming in the space. A lot of bigger organizations who are also entering the space, because as you know, the government has now mandated that in the next, I would say, to 2029, they want close to 90% plus of the defense spending to be happen in-house within, our own domestic companies. Apart from that, the government also has mandated a huge amount of exports to happen. Already, I think Indian companies do export to 100 plus countries. So we do believe that this space is going to explode. There's going to be a lot of companies and a lot of who are coming and buying up for the huge defense budget. So we believe that it's a big space. However, having said that, valuations in this space have been quite premium over the last 4 to 6 months' time. So we believe that the space requires some sort of earnings to catch up for valuations to sort of stabilize, and maybe you could see some run up in the stocks again.
Okay, Pratik, so when you guys think about a longer term theme, how do you guys think about a theme like that? Because people usually get caught up, and maybe rightly so, caught up may be wrong word, into the current valuations. And at times, people who are constructive on a theme which is expensive talk about the really longer term growth tenor and how some of these valuations might look very cheap or pedestrian at some years out. So is defense that kind of a theme? How do you think about that aspect?
Yeah, so it's a good question. So, valuations can be seen from two purposes. Are they valuations expensive because of the company, because of the sector, or because of growth? We believe that defense as a subsector, which, comes under manufacturing as a theme, is actually going through a huge growth period. Just for example, over the last few years, we're looking at profitability of these companies growing at 50%, 60%. Last 1 year, you're looking at profits grown at about 65% of these companies, all of them, if you combine them. So we believe that, growth has been the driver of higher valuations in the space. Having said that, I think if you have high valuations with no growth, that is when obviously investing can get tricky. And that's when, you can expect valuations to not really, catch up with earnings. We believe as a house that defense over the long term is obviously in excellent theme. A lot of these stocks that are already there in our defense index fund that we launched about a few months back, are already owned. So as a house, we're very positive about manufacturing and defense as a theme. We believe that over the next decade, if you look at India, our primary exports used to be IT and pharmaceuticals, so healthcare and well, mostly pharma and IT, but manufacturing can be this third vertical as the world sort of diversifies away from China. So we believe that under manufacturing defense can play a big role. You're already seeing big orders coming in. I think the risk in defense is not on the order book side; it's more on the execution side. Are these companies in this sector able to execute in a timely manner so that they are able to take these orders and convert them into P&L. So I think that is something that is to be seen. So far, they've done a very good job in expanding capabilities, production. So that is a space which we need to look out for. But yes, I think growth potential is there, and obviously because it's a very high tech industry, profit margins also tend to be very good because you're looking at companies that have to. It's very hard to be a part of SIDM or Society of Indian Defense Manufacturers. So I think in that sense, not any company can sort of enter the space. So barriers to entry are also quite high for the space.
Got it. Okay, Pratik, how does one use the options at the Motilal Oswal AMC or the Motilal Oswal AMC house to invest into this? Because I believe you have an ETF and an index fund both.
Yes.
So tell us a bit about this. Yeah,
absolutely. So we launched two funds over the last 3 months. Both are tracking the same index, which is the Nifty India Defense Index. It's an index where essentially looking at investing in about 12 to 13 stocks because that's the unfortunately there are only few number of stocks that qualify for this index. Hopefully we'll see a lot more going forward. So you're essentially looking at an index which is about 13 stocks, and how does the selection happen? The stocks basically have to be a part of the SIDM, which is the Society of Indian Defense Manufacturers, and about 10% of the revenue of these companies have to come from the defense sector directly. So that is how the stock selection happens, and 13 companies sort of qualify for this. This is a passively managed fund, so there is no active stock picking. There is no fund manager who's taking a call about what stock to buy, what stock to sell. You're essentially just tracking the Nifty India Defense Index. And that's how this sort of index is constructed. The index is rebalanced about twice a year in March and September, and there is obviously a maximum stock of 20%. So no stock can go above 20%, which I think is hygiene because defense tend to be. If you look at the current index, it is very large cap and small cap oriented. So to avoid sort of very high stock concentration, which is not what you want from a mutual fund, the 20% stock cap. So it's a very simple index. It tracks the performance of defense companies, and it's available in index fund format, which in our experience has been a lot more popular than ETFs. The ETF is something that we also launched, about a month and a half, 2 months back, and that's also an option for investors who are willing to who prefer ETFs or index funds or just want to buy the ETF. So both formats available. The return should be pretty much the same, and the idea is to track companies in the defense space. Again, just to reiterate, this is a thematic fund. So, we do ask our investors to really look at the long-term potential of the sector as opposed to looking at from a 3 to 4 months perspective or even a 2-year perspective may not be good enough. As a house, we're very bullish on this subsector, and all the positive levers are there. We just obviously think that over the long term, this is where one theme where we believe there could be good wealth creation.
Pratik, how would the number of stocks in this index increase? Is it a factor of companies merely becoming a part of that particular society, SIBM or something that you were talking about, or are there other factors to this?
Yeah, so that's the methodology. So this methodology is set by NSE indices. It's a very simple methodology. It's essentially companies that are part of the SIDM, which is the Society of Indian Defense Manufacturers. So that's the group that it has to be a part of. It has to qualify for that group. And also, a lot of companies qualify, but the revenues may not be significant. So the idea here is to ensure that about 10%, at least 10% of the revenues are coming directly from the defense sector, which makes it quite significant. So if a company qualifies for these two criteria, then obviously they'll be part of the index. So currently there are about 12 to 13 companies in this index. We hope that there'll be a lot more in the future.
Okay. And Pratik, one final question really, and considering that it's a passive fund, I'm presuming you're not responsible technically for the performance because it's tracking an index. right? You can correct me if I'm wrong, unlike an active fund. But are there some base benchmark expected returns over a, let's say, 5-year period that you envisage that this index, or therefore on the back of that, investors in this fund can get?
Yeah, no, it's a good question. So obviously, we are responsible for launching funds, and we obviously have tons of funds that we could launch. We believe that the methodology or the decision making of why we launch certain funds is because we see wealth creation opportunities in them. So I think this particular index is an index where we see wealth creation. What does that mean? In finance, obviously, if you're taking higher risk by investing in a sector or thematic fund, you would expect it to obviously come with more volatility, but you also expect it to give you slightly higher returns than what you would get in say a Nifty 50 or a Nifty 500. At least our internal expectation is that over, say, a 5 to 7 year period, which is what most investors should do when looking at equity funds, because equity funds tend to be very, you need to take a 5 to 7 year call for equities. We do expect investors to make some sort of premium over the Nifty over the long term. Having said that, the problem is that a lot of investors are being swayed by the past returns. We have repeatedly said that obviously the sector has had a huge run, and valuations are also very expensive. So investors should keep in mind that keep their expectations not as high as what it's been in the past, which is 40, 50, 60%. It's super unlikely that that scenario may happen. Obviously, no one knows, but it's very unlikely from a probability perspective that you will see the same amount of performance in the future.
That's well said, and it's always good to hear the manufacturer of a product sound out the bugle of caution as well. So Pratik, fairly responsible to do that. Thanks so much for doing that, and thanks so much for being a part of the Mutual Fund Show today.
Thanks, Neeraj. Thanks for having me.
The pleasure was ours. Well, viewers, there you heard it, and it's good to hear a word of caution as well, because a thematic fund, you need to have that word of caution too. It's not for everybody. Bear that in mind, as I believe my next guest on the show will tell. But let me not preempt that. Allow me to let Shalini Dhawan make those comments herself. Maybe she differs from this. She's director and co-founder of Plan Ahead Wealth Advisors. Joins us on the show. Shalini, good having you. Thanks for joining in.
Hi.
We chose.
Hello, Neeraj.
Yeah, it's been a long time that we've spoken, so I'm glad we're talking today.
Yeah, thanks for having me here.
No, the pleasure is ours. Shalini, what kind of people should take exposure to thematic funds per se? I mean, it should maybe not be a part of the core, but a satellite portfolio. But still, would you, in your wisdom, think that people should start approaching a thematic fund only after boxes A, B, C, D are ticked? What are those boxes?
Yeah, you're right to think in that direction. I would say that, investors who are new to, say, equity investing, for example, or newer to even mutual funds, we do come across a lot of investors who are recently being very attracted because of certain higher returns from, thematic funds, like, for example, the defense theme that we're talking about. I think you're right. There has to be a gradual understanding of risk and returns. Usually investors are, more enamored by the returns, and they forget risk somewhere. So after you've possibly done, some investing in, even debt mutual funds, and even then diversified, equity mutual funds, I think beyond that, possibly after a few years of continuous investing in equities, and you have that better confidence and investing experience, can one actually venture into a thematic fund, I would say, because of the risk matrix being much higher than your usual diversified equity fund.
Okay, now having said that, where do defense funds, any defense funds, I'll come to Motilal Oswal in a bit, where do any defense funds fall under, therefore, with that criteria?
Yeah, clearly, as you said, thematic funds, now whether earlier we had many different themes, like we had infrastructure, which was a theme which was very popular at one point in time. Even today, sometimes people are looking at banking or they are looking at IT. So just like one can slice any sector and make it a very strong concentration or a theme for that matter. I think defense would possibly also sit in the same basket of being, as we understand thematic funds, they are high risk and therefore high return. The caution, like everyone should understand, is the high risk sometimes plays out, and the high return is not, a guarantee. The recent last couple of let's say about a month or so also is a case in point for the same sector that we're talking about. Is that it had a tremendous big double digit, like some 70% kind of returns if you see a 1 year return. But if you see the last 1 month or so, because of certain volatility in certain stocks, we are seeing like a little bit of a downtrend in the same sector and scheme.
Okay. Now there are active funds, there are passive funds. There is this Motilal Oswal product which effectively tracks an index. Now, how do you differentiate between one versus the other? Considering that there is one which is passive and one is and some others might be active, but within passives as well, if there is a tracking of an index which has got 13 stocks and the criteria for making it to the index are also difficult, and therefore it's not exactly a complete representation, if you will, of the defense sector, right? So Shalini, how do you think about all the products available?
So obviously, one is that this theme itself is fairly new. So to that extent, investors have to be a little bit more cautious. I think the first scheme in this theme was introduced sometime June of last year. So that's also just completed about a year. And then we have a few new entrants that we have now, which are more on the passive side, where they are taking basically investors' money into a nifty defense index fund, so to say. Obviously, the differences would be in approach. Obviously, passive will not have as much room, to diversify the universe, if at all, we can say that. Whereas an active would have a little bit more room to add a little bit more longer list of portfolios if they wanted to diversify the investors' money coming in. So to that extent, I think the passive players will have a little less room in that sense, and they would run the risk of a little higher concentration. So probably the top 10 stocks would have like a 80-90% kind of weightage in the portfolio construction. The benefit of a passive fund obviously would be that it will have a lower expense ratio. So in times when or in years when you do not have that good return coming in, you're kind of having a buffer that your expense ratio on your investments is a little lower, but it's just a tad lower. So I think it's important to kind of give it a little bit more time from an investor's perspective to see how and where and which schemes they want to invest their money in. At this point in time, from what I understand, the existing schemes also, which are active, also do have higher concentration because the universe itself is fairly small. As I understand on the theme. So broadly, a little bit of differences in terms of portfolio construction maybe from the product manufacturing side can happen. And of course, a lower expense ratio on a passive fund. These would be possibly the differences.
Got it. Okay, great. Shalini, so in a nutshell, if somebody wants to go out and take a risk, is the Motilal Oswal instrument a good one, or would you choose an actively managed fund in a nutshell?
I mean, personal view here again, obviously someone which has a higher track record, I would possibly go with that kind of scheme. Having said that, the current longer track record scheme, which is the HDFC one, is actually not taking in investor money, as I understand at this point in time. Even SIPs have been stopped. I think the possibly it's a matter of timing in terms of the valuation of the schemes. Actually, at this point in time, I would actually reiterate to say that I would not be investing in this sector because the valuations have run up a little bit beyond what would be reasonable. And maybe from an investor perspective, if I were to look at it, there's not so much margin of safety if you're basically buying at higher valuations. At another point in time, thematic, in a sense, yes, of course, people can invest, some part of their money in thematic. As we started the conversation, we said that, it cannot be a strategic portfolio. It has to be something that's tactical. It has to be something, again, that's because it's higher risk, your orientation on, investment horizon should be like 5 to 7 years. But yeah, I mean, at this point in time, one has a little higher, longer track record, just like about a year. The other ones are fairly new. But also, broadly, neither would be my suggestion at this point, because the sector itself or the players there have, kind of run up in valuations quite a bit.
Got it. Okay. Shalini, some queries as well. Now, beyond defense, and I would love for you to answer and help our viewers. First one is from a gentleman called Yogesh Dilip. Yogesh is 30 years age. The goal is 1 crore in 15 to 20 years. Started investing 11,000 rupees per month in mutual funds this month. Is it advisable to continue under the current market scenario, or should he wait for the markets to go down?
So I would think that if someone is looking for equity investing, as we tell all investors, long-term horizon, he's already thought of 15, 20 years. So I think that's great. I think he can take that 11,000. I think the secret here is consistency, is that how can he continue his SIPs over that 10, 15, 20-year horizon. If he is able to at a long-term rate of return, if we assume around 12%, which has been long-term over 15 to 20 years, what the market has given, then he would end up with a 1 crore corpus in 20 years' time.
Okay, so, well, stick to the guns, Yogesh. I think that will help you, considering the time horizon is long enough. Pramod Sulikeri. So that's a fairly easy query, really, Yogesh. But let's get to the other one. Pramod Sulikeri, age 62 years, Shalini, is asking about whether it's a good idea to invest in contra funds now, and do they offer enough diversification?
So yeah, I mean, contra funds by their name itself are contrarian in nature. They would obviously invest in stocks or sectors which are actually out of favor, or maybe are strong companies, strong balance sheets, but are going through either a downtrend, a bad patch, or something that they would need a few years to come out of. So usually, contra scheme fund managers would invest that way. Yes, there could be a concern around portfolio concentration. So if that's something that's just like you're fresh into mutual fund investing, then I wouldn't suggest contra funds. Then I would possibly suggest maybe even taking a very long-term view on a simple diversified equity fund, or a flexi cap fund, or a value fund. Contra, by as we explained, could have some calls of the fund managers going wrong. So if they had a shorter horizon, then probably even then, a 5 to 7 year horizon for a diversified equity fund would be, or a flexi cap would be better than contra, because as the investor has correctly pointed out, there could be higher portfolio concentrations because fund managers may have conviction in their ideas and may kind of make a concentrated portfolio based on the contrarian strategy.
Got it. Okay. Shalini, one final question from Syed Yaqub. Syed says, Syed is age 32, is contributing 4,000 a month to NPS and have a 5-month LIC life insurance policy. Looking to invest 5,000 rupees in mutual funds. What are some good bets? Looking to invest in small caps. No time horizon given.
Right. So again, I think good that someone in their 30s has got a good spread like NPS, LIC, and now mutual funds. Again, I would say that probably just like we discussed, valuations are quite important when you look at investing. Small caps by their nature are usually high risk and high return. So the high return is what usually is attracting investors, which is what's happening with a lot of mid cap and a lot of small cap schemes and a lot of mid cap and small cap stocks. They're attracting a lot of investor attention. At this point in time, based on the valuations that small cap schemes are looking at, I would suggest for him to basically look at either a flexi cap fund like Parag Parikh flexi cap or HDFC flexi cap, or a value fund like DSP or ICICI Value Discovery. I'm assuming that this is not his first and only mutual fund scheme. If that were the case, I would actually stick to a very simple SIP or a mutual fund scheme like UTI Nifty Index, which basically is a passive scheme. It just basically mirrors the Nifty 50 for the investor, and the investor can expect to get index-like returns into the SIPs or the equity mutual fund investments that he or she is doing. But yes, if they are someone who's quite like understanding mutual funds or accustomed to investing in mutual funds, then yeah, one could look at the flexi cap or even the value category. Those look a little bit more reasonable in comparison to the small cap space.
Got it. Okay. Shalini, really appreciate you taking the time out and giving us all of these insights. Much appreciate. Thanks for joining in.
Thank you. Thank you.
And viewers, with that, it's a wrap on this leg of the Mutual Fund Show.